Picture this. You open your retirement statement on a quiet Friday morning, coffee in hand, and the number staring back at you is smaller than it was last week by an amount that makes your stomach drop. That feeling, that cold little jolt in your chest, is exactly what hundreds of thousands of American 401k holders are living through right now after the June Fed meeting. And I want to sit down with you and talk about it honestly, the way a friend who's been burned before would, not the way a glossy financial channel sells you a dream. I'm Kunal, the guy behind Failed Finance. And the whole reason this channel exists is because I've made my share of expensive mistakes chasing the hot thing. So when I tell you to pay attention to what just happened to mega-cap tech, it comes from a place of scars, not arrogance. Here's the raw truth about the sell-off. For the last 2 years, the market told everyone a beautiful story, that artificial intelligence was a money-printing machine, and that any company with the letters A and I anywhere near its earnings call deserved a sky-high multiple, and investors believed it so completely that they poured trillions into chips, data centers, and cloud capacity. But the awkward part nobody wanted to say out loud finally got loud after the Fed signaled it wasn't in any hurry to cut rates. All that spending hasn't actually shown up as fatter profits yet. Think about that for a second. Companies are burning enormous capital, building the picks and shovels of the AI gold rush, the GPUs, the server farms, the power contracts, and yet corporate margins on the whole have basically frozen in place. When you spend like a champion but your bottom line stays flat, Wall Street eventually stops giving you the benefit of the doubt, and that's the exact moment we're in. The Fed's hawkish posture is the trigger here, and the mechanics are simpler than the headlines make them sound. When interest rates stay higher for longer, money sitting safely in a treasury bond or a high-yield savings account suddenly looks attractive again, which means investors no longer feel forced to gamble on a tech stock priced for perfection just to earn a return. So they do the rational thing. They rotate out of the most expensive, most hyped names and into things that feel safer. That rotation is not gentle. It hit the semiconductor space hard, the chip index that tracks the companies everyone bragged about owning, and it bled into the AI cloud platforms and even the retail brokerage apps that thrive when everybody's day trading the latest momentum darling. Let me ask you something directly, and I genuinely want you to think about it before you keep watching. When was the last time you actually looked at what's inside your 401k? Not the total dollar figure, but the breakdown. Because here's the trap so many smart, hardworking Americans fall into without realizing it. You sign up for your employer plan. You pick the fund that's been performing best, you set it and forget it like every blog told you to. And over the past 2 years, the fund that performed best almost certainly loaded up heavily on the same handful of giant tech names, which means you might be far more concentrated in AI and big tech than you ever consciously chose to be. Your diversified account could secretly be a leveraged bet on one single theme. And I have to be clear with you here, because this matters. I'm not a licensed financial advisor. Nothing I say is personalized advice for your specific situation, and you should treat this as one guy thinking out loud who wants you to ask better questions, not as instructions to follow blindly. With that said, let's talk about the part that actually empowers you instead of just scaring you. The answer to a moment like this isn't to panic sell everything at the bottom, because that's how people lock in losses and then miss the recovery, and it isn't to stubbornly hold a wildly lopsided portfolio while telling yourself it'll bounce back. The answer is something boring and unglamorous that the wealthiest, most durable investors have preached for decades: rebalancing. Rebalancing simply means bringing your portfolio back to the mix you actually intended, trimming the slice that grew too big and got too risky, and redirecting some of it into areas that hold up better when the economy gets nervous. And this is where the philosophy of someone like Warren Buffett becomes more than a bumper sticker quote. Buffett famously sat out the entire dot-com boom in the late 90s, got mocked relentlessly for it, was called a washed-up old man who didn't understand the new economy, and then watched calmly as that bubble vaporized fortunes while his unglamorous holdings stood firm. His lesson wasn't that technology is bad. It was that price matters, that paying any price for a great story is how you go broke, and that the goal is to be greedy when others are fearful and fearful when others are greedy. 2 years of everyone screaming about AI was peak greed. So if you've been feeling that anxious flutter every time you check your balance, sit with this idea instead of running from it. Where would you naturally rotate when the crowd is fleeing risk? That brings us to two categories worth understanding deeply, and I'll break those down piece by piece in just a moment. Because the difference between consumer defensive and consumer discretionary stocks is something every single person watching this should be able to explain at their own dinner table by the time we're done. Before I get into that, if this is hitting home and you've never thought about your retirement account this way, do me a favor and drop a comment telling me one thing. Is your 401k mostly in a target date fund, an S&P 500 index, or individual tech names? Because I read these, and the patterns I see in the comments genuinely shape how I make these videos. Now stay with me, because the strategy part is where this gets useful. So let's get tactical about defense, because understanding the problem is worthless if you don't know what to actually do with your hands on a Monday morning. Consumer defensive stocks, sometimes called consumer staples, are the companies that sell the stuff Americans buy no matter what the economy is doing, whether the headlines scream recession or boom. Toothpaste, laundry detergent, packaged food, household cleaners, the soda in your fridge, the over-the-counter medicine in your cabinet. When people get scared and cut spending, they cancel the vacation and the new gadget, but they do not stop buying groceries or brushing their teeth. And that predictability is exactly what makes these companies steady ballast in a storm. They won't make you rich overnight, and that's the point. They're not supposed to. Consumer discretionary, on the other hand, is the flip side. The companies that sell the things people buy when they feel financially comfortable. The restaurants, the travel, the home renovations, the premium streaming bundles, the new sneakers, and here's the nuance most surface-level videos miss. Discretionary can actually be smart positioning too, but only the right kind. The durable brands with pricing power and loyal customers rather than the speculative names. The real move isn't slamming everything into one bucket. It's building a mix that doesn't live and die by a single Fed announcement. Now let me give you a concrete, practical action plan. And again, please filter all of this through your own situation and ideally a professional who knows your full picture. Because I'm sharing a framework, not a prescription. Step 1. Pull up your actual fund holdings this week, not next month, and find the top 10 positions. Most 401k providers list them, and target date funds publish them too. If more than a third of your money sits in 5 or 6 tech-adjacent names, you've found your concentration risk, and now you can see it instead of being surprised by it. Step 2. Look at your contribution allocation separately from your existing balance, because here's a move people overlook. You don't always have to sell anything to rebalance. You can simply redirect your future contributions, every paycheck going forward, into different funds, which gradually shifts your mix without triggering a single sale or any tax friction inside a 401k. That's the gentlest, lowest stress way to course correct, and it's perfect for someone who's nervous about timing the market. Step 3. If your plan offers them, look into broad index funds beyond the tech-heavy ones, a total market fund or a value-tilted fund, or a fund that includes staples and healthcare, so your eggs stop sharing one fragile basket. Let me ground this in a real American story, because abstractions don't stick. Think back to 2022, the last time the Fed got aggressive and tech got hammered. The people who got hurt worst weren't the ones who owned tech. They were the ones who owned only tech. The folks who'd watched their accounts double in 2020 and 2021 and convinced themselves the party was permanent. And many of them then panic sold near the lows in late 2022 and missed the violent recovery in 2023. The ones who slept fine were the boring rebalancers, the people who'd trimmed their winners on the way up and held a spread across sectors. And when one part of their portfolio fell, another part held its ground. That's not luck. That's design. And this connects right back to why I named this channel Failed Finance. Because my own biggest mistake was exactly that overconfidence, watching a single position run up and refusing to take any chips off the table because selling felt like admitting the ride was over, and the market taught me the lesson the expensive way. Here's the mindset shift I want you to walk away with. A downturn like this isn't purely a threat. It's also the market handing disciplined people a chance to buy quality at lower prices, and to fix an allocation they should have fixed when everything was green and easy. Buffett's whole fortune was built on staying calm and buying value, while the crowd was either euphoric or terrified, never in the middle. And you have that same option available to you right now inside your own retirement account. So let me leave you with a question I'd love you to actually answer in the comments, because your responses are the best part of doing this. After watching this, what's the one change you're going to make to your 401k this week, even a small one? Write it down, type it out, make it real, because the people who say it out loud are the ones who actually do it. If this gave you a clearer way to look at your own money during a scary headline cycle, subscribe to Failed Finance so the next one finds you, and share it with someone whose retirement might be quietly riding on a single bet they don't even know they made. Because honestly, that one conversation could matter more to them than they'll ever realize. And at the end of the day, that's the whole reason I keep showing up to do this.